Welcome to the deep dive. Today, we're going to unpack something really critical in the financial world. It's about how auditors handle companies that, rely heavily on other companies for key services. You shared some great info on ISO 402.
IAS, International Standard on Auditing 402. It's fundamental stuff.
Exactly. And stick with us, everyone, because understanding this is sort of like getting a backstage pass.
Right, a backstage pass to how financial accountability really works.
Yeah.
Especially now, when everything's so interconnected.
Yeah, absolutely.
So whether you're prepping for a big meeting, or just brushing up on audits, or maybe you're just curious.
Which is totally fine.
Totally. This deep dive should give you the essentials on ISO 402. We're focusing on these service organizations.
Like cloud platforms, payroll companies, that sort of thing.
Precisely. And how auditors make sure using those services doesn't mess up the company's financial reporting. We'll look at, the key things auditors consider, the reports they use.
Okay, so first things first. What exactly is a service organization here? It sounds like it could be almost any vendor a company uses.
That's a fair question. It can seem broad, but ISO 402 gives it a specific meaning.
Okay.
A service organization is basically another company that provides services to your company, the user entity.
Right.
And crucially, those services are part of the user entity's information system, specifically the part relevant to financial reporting.
Ah, okay, so it has to tie into the financials.
Exactly. So think about a company outsourcing its sales processing or maybe its entire accounting system. Those providers, they become really integral to the financial data, the stuff that ends up in the financial statements.
Got it. So maybe a company uses a third-party platform for, say, recognizing its revenue.
Yeah.
And that data flows right into their books. That provider would count.
That sounds like a very likely candidate, yes.
Can you give maybe another example or two straight from the standard?
Sure. The standard explicitly mentions things like processing transactions and maintaining accounting records. But you can easily see how that extends.
Right.
Like maybe a fund manager handling investments for a company.
Yeah, makes sense.
Or data center that hosts the company's main financial software. All service organizations under ISA 402. The key is always that direct link to financial reporting.
Okay, I think I'm getting the picture. Now, why should someone just reading the audited financials care about these behind-the-scenes players? Why can't the auditor just focus on the company itself?
Well, that's really the heart of it. If a big chunk of a company's financial info or the processing of it is handled externally, the company's auditor needs to be sure. They need confidence that the systems, the controls at that service organization aren't introducing errors. Or worse, enabling fraud.
Right. Errors that would then flow into the company's own books.
Exactly. And the more important that service organization is to the company's financials.
The more the auditor needs to dig in.
Precisely. The deeper their understanding needs to be about what's actually happening over there at that third party.
So for someone like me, or anyone trying to be well-informed about a company, knowing about these key service providers and knowing the audit looked at them is actually pretty essential for trusting the final audit opinion. It's like you need to know the whole supply chain.
That's a great analogy. The supply chain of financial information.
Yeah.
Because, an audit report might look perfectly clean on the surface.
Right.
But if the auditor hasn't properly checked the impact of a major service provider, there could be hidden risks. It's about seeing the full picture, how the data gets made and moved around.
Okay, so the auditor needs to get smart about these service organizations. How do they actually go about that? What kind of info are they after?
They need a pretty solid understanding, not just of the services, but critically, the internal controls of the service organization that relate to those services.
Internal controls. Okay.
Yeah. ISO 402 points to a few key areas. They need to understand the nature of the services. How significant are they really to the company's reporting?
Makes sense. What else?
They also need to look at the nature and materiality of the transactions being processed.
Materiality. Right. So how big are the numbers involved?
Exactly. Or which specific accounts are affected by what the service organization does.
Okay.
And then there's the interaction. How do the company and the service provider actually connect?
You mean, like, technically? How do the systems talk to each other?
That's part of it, yeah. What data flows back and forth? How is it kept secure? What are the responsibilities laid out in the contract?
The contract. Important.
Very. And fundamentally, the auditor needs to understand the service organization's own internal processes, policies, controls, Basically anything relevant to the user company's financial reporting.
Wow, okay. It sounds almost like the auditor is doing a sort of mini audit
In a way,
of the relevant bits of the service organization, even though they aren't their auditor.
it's not a bad way to think about it.
So where do they get all this information? It seems like it might be tough to just walk into a third party and ask for all their internal control details.
Right, it's not always straightforward. But there are various ways. ISAF 402's guidance mentions a few.
Like what?
Well, sometimes the service organization provides user manuals or system overviews. Those can give some insight.
Okay. Documentation.
Technical manuals, too, detailing IT setups, security. The contract, as we said, is often crucial. And, very importantly, the service organization might actually have reports prepared about their controls, often by their own auditors.
Okay, so there might already be an audit happening at the service organization.
Potentially, yes.
Yeah.
Specifically focused on their controls relevant to their customers.
And that leads us to these service auditors reports. What are they and why are they so useful for the auditor of the company using the service?
Good question. A service auditor's report is basically an independent assessment. An auditor looks at the controls at the service organization.
Okay.
And it gives the user entity's auditor a way to get some assurance about those controls without necessarily having to go and test everything themselves at the third party.
Right, saves them from maybe having to do that mini audit themselves.
Exactly. It provides evidence.
Yeah.
And ISF 402 really focuses on two main types, Type 1 and Type 2 reports.
Type 1 and Type 2. Okay, let's break those down. What's the key difference?
Okay, so a Type 1 report, it mainly focuses on the description and the design of the controls.
Description and design.
Yeah. At a specific point in time, think of it like a snapshot. It says, here's what the service organization says its controls are. Here's our opinion on whether that description is fair and whether those controls seem designed effectively as of, say, December 31st.
Okay, so it's about the blueprint, the plan, as of one date.
Pretty much. It includes management's description of their system and the service auditor's opinion on that description and the design.
Got it. So what about Type 2 then? Sounds like it must go further.
It does. Significantly further.
Yeah.
A Type 2 report covers everything in a Type 1.
Okay.
But it also covers the operating effectiveness of those controls.
Operating effectiveness. So did the controls actually work?
Exactly. And not just at a point in time, but over a specified period, usually 6 months or a year.
Okay, that's a big difference.
Huge. So the Type 2 includes the service auditor's opinion on the description, the design, and the operating effectiveness. And crucially, it also includes details of the tests the service auditor actually performed on those controls and what the results were. Did they pass? Were there exceptions?
Wow. Okay, now that's interesting for someone like me trying to understand how solid an audit is.
Right.
A Type 1 says, here's the plan, but a Type 2 gives you some real evidence that the plan was actually followed, that the controls were working over time.
You've got it. And this distinction is really important.
How so?
Well, a Type 1 report, it gives you some understanding, sure. But its big limitation is it offers zero assurance that those controls actually operated effectively throughout the period.
Right, just that they looked okay on paper on one day.
Exactly. A Type 2, because it tests operating effectiveness, gives the user auditor a much higher level of comfort, much more assurance.
So if you see a company relies heavily on a service provider, knowing whether their auditor looked at a Type 1 or a Type 2 report from that provider, that tells you quite a lot about how deep the auditor went.
It certainly can, yes. It indicates the level of evidence they obtained about the controls at that third party.
That really is an aha moment. It reveals this whole other layer of scrutiny and audits that I hadn't quite grasped before.
It's a critical layer in today's environment.
Okay, so the company's auditor gets this understanding maybe from a Type 1 or Type 2 report or other ways. How do they then use that to figure out the risk of problems in their clients' financials?
Right. They take that understanding of the service organization and its controls.
Yeah.
And they use it to identify and assess the risks of material misstatement back at the user entity, their client.
So if the service provider handles something really important, like, say, all the company's revenue transactions, and the auditor sees potential weaknesses in the service provider's controls, maybe from a Type 2 report showing exceptions,
then yes, that would likely increase the assessed risk of misstatement for revenue in the company's own financial statements.
Okay, it makes sense. Risk goes up. Now, what does the user auditor actually do in response? Do they just note the risk and move on? Or file the report?
Oh, no, they have to respond. Their actions depend on the specific risks they found and how significant the service is.
Right.
IS 402 lays out options. As we said, Getting and evaluating a Type 1 or Type 2 report is a key step.
Okay.
And the type of report and what it says influences what comes next. A Type 1 might give some understanding, but since it doesn't test effectiveness.
The auditor might need to do more testing themselves back at the company.
Exactly. They might need to perform tens of controls at the user entity that relate to that service, or more substantive testing on the balances affected. A Type 2 report showing effective controls might reduce the need for that.
What if there isn't a service auditor's report? Or maybe the report exists, but it doesn't cover the specific thing the user auditor is worried about.
Good point. That happens. In that case, the auditor has other avenues.
Such as?
They might need to contact the service organization directly, ask for specific information relevant to their audit needs.
Okay. Direct contact.
Depending on how crucial the service is and the level of risk, they might even decide they need to visit the service organization.
Visit them? Like go on site?
Yes, and perform their own audit procedures right there. It's less common, perhaps, but it's an option.
Wow.
Or another possibility is using another auditor, engaging someone else to go perform specific procedures at the service organization on their behalf.
Okay, so they have a toolkit of responses.
Exactly. The main point is they can't just rely blindly or ignore it. They have a responsibility to gather sufficient, appropriate audit evidence one way or another.
So the user auditor really has to think on their feet, assess the risk, look at the evidence they have, like a Type 1 or 2 report, and then decide, okay, is this enough or do I need to do more? Could be reviewing the report, could be talking to the provider, could even be going there themselves.
That's it, precisely. It all comes down to exercising professional judgment to get enough reliable evidence to back up their opinion on the company's financials.
Now, you also mentioned something called subservice organizations. This sounds like outsourcing. Outsourced, like layers of it.
You could say that, yeah.
Yeah.
It adds another layer of complexity.
So what is a subservice organization?
It's basically a service organization used by another service organization.
Okay, wait, give me an example.
Sure. Think about our payroll processing company again. They're a service organization for their clients, right?
Right.
But maybe that payroll company uses a different third-party data center to host all its computer systems and data.
Ah, I see. So the data center is providing a service to the payroll provider.
Exactly. In that scenario, the data center is a subservice organization.
Okay. So how do these Type 1 and Type 2 reports usually handle that? Does the report on the payroll provider also cover the data center they use?
That's a really critical question when you're reading one of these reports, because sometimes they don't.
They don't cover the subservice org.
Correct. Some Type 1 and Type 2 reports are issued under what's called the carve-out method. They specifically exclude the services provided by certain subservice organizations.
They carve them out?
Yeah. The report will clearly state that it covers the controls at the main service organization, but not at the subservice provider mentioned.
Okay. And what does that exclusion, that carve-out, mean for our user auditor? The auditor of the company using the payroll service. Sounds like another potential gap, a blind spot.
It can be, exactly. If the subservice organization's activities are relevant to the user company's financial reporting, like the data center hosting the payroll data, certainly would be, and they're carved out of the main report.
Then the user auditor can't rely on that report for assurance about the data center's controls.
Precisely. They need to consider the impact of those carved-out services. They might need to get information about the subservice organization's controls separately.
How? Would the subservice org have its own Type 1 or 2 report?
Sometimes, yes, that would be ideal. Or the user auditor might need to go back to the main service organization, the payroll provider, and ask how they monitor the controls at their subservice provider. Or in some cases, the user auditor might need to perform other procedures themselves.
Wow. It just adds another layer they have to think through. Assess the risk from the subservice org, figure out if the report covers it, and if not, find another way to get comfortable.
It really shows the interconnectedness, doesn't it? Auditors have to follow that chain. It's not just about the primary vendor anymore.
Definitely highlights that complexity. Now, what about really serious stuff, like fraud? Or maybe the service organization isn't following laws or regulations. Does the user auditor have to worry about that happening at the third party?
Yes, absolutely. Their responsibility extends there too, at least in relation to how it could affect their client.
How so?
The user auditor needs to consider the risk of fraud or non-compliance with laws and regs, or even just uncorrected mistakes.
At the service organization?
Yes, at the service organization, but specifically things that could materially impact the user entity's financial statements.
Okay, so it has to potentially flow through and cause a problem for their client.
Exactly. Think about our payroll processor again. If they weren't complying with, say, tax withholding regulations,
Right?
that could directly lead to misstated payroll expenses or liabilities on the client company's books. The user auditor needs to consider those kinds of risks.
Or if there was some big internal fraud scheme at the processor that inflated payroll costs charged to clients, the user auditor needs to have procedures that might catch that impact.
They need to consider that risk as part of their overall audit planning and execution, yes.
Okay. So finally, how does all this reliance on service organizations, the type 1 or 2 reports, maybe even dealing with subservice providers,
Yeah.
how does it affect the user auditor's own final report, the opinion they issue on the company's financials?
Generally speaking, the user auditor's report is just about the user entity's financial statements. ISO 402 is quite clear. The user auditor should not typically refer to the work of a service auditor or their report in the user auditor's own report.
They don't mention the type 1 or type 2 report.
Not usually. There are a couple of exceptions, like if it's required by law or regulation, or if the service auditor's report itself has a modified opinion, meaning the service auditor found significant problems with the controls.
Ah, okay. So only in specific, usually problematic circumstances.
Right. And even then, crucially, making reference to the service auditor's report doesn't reduce the user auditor's own responsibility. Meaning the user auditor can't weaken or qualify their opinion on the company's financials just because they relied on a service auditor's work. They can't say, well, these financials are okay, except for the parts handled by the service provider where we relied on their auditor.
Right, so the user auditor can't just pass the buck and say, hey, the service provider's auditor looked at it, so if something's wrong there, it's not on us.
Absolutely not. The user auditor owns their opinion on the user entity's financial statements, full stop. They use all the information gathered about the service organization, including any reports, to inform their own risk assessment and tailor their own audit procedures.
Back at the client company.
Exactly. To get enough evidence to support their overall conclusion on whether the company's financial statements, as a whole, are fairly presented.
Okay, wow. Let's try to wrap this up then. We've really gone deep into ISA 402 and this whole world of auditing service organizations.
We certainly have.
We've talked about what they are, why auditors of the companies using them need to understand them so deeply.
The significance.
We dug into the difference between Type 1 and Type 2 service auditor reports, that key distinction about testing operating effectiveness.
Crucial difference.
And how user auditors actually respond to the risks they identify, the toolkit they have.
Right. Evaluating reports, maybe contacting the provider, maybe even visiting.
Yeah, and we touched on the extra wrinkle of subservice organizations.
The carve-outs.
Right. And the auditor's responsibility for things like fraud or non-compliance over at the service provider if it affects their client. And finally, how it all culminates in the user auditor's own report, where they retain full responsibility.
That's a fantastic summary. It really covers the main points of how auditors navigate this complex web of outsourced services to ultimately provide assurance on the financial information we all rely on.
It really does. It's much more involved than I think most people realize goes into a standard financial audit these days.
It has certainly become more complex with increased outsourcing.
And maybe on that note, here's something to chew on, something to think about after this.
Okay.
Businesses are just relying more and more, exponentially it feels like, on specialized third parties for everything. You know, sophisticated data analytics, critical cybersecurity, even core business functions.
True, the trend is undeniable.
So given that, how might these principles we've talked about today, the ones in ISO 402, how might they become even more central, even more vital in the future? You know, for making sure financial reporting stays transparent and trustworthy.
That's a great question to ponder.
Yeah. It seems like this framework isn't just about compliance today. It's really a lens for understanding how business and audits have to keep evolving together. Anyway, thanks for joining us on this deep dive.